So Tobias, thank you for your time. And first of all, can you tell us, for our viewers who might not be that familiar with the concept green finance, what exactly is green finance?
So green finance means that investors invest in stocks and bonds that have a certification to be subject to certain standards. So those are typically ESG standards, environmental, social, and government-friendly standards. So that's the broader asset class. And within the ESG asset class, there is a specific climate segment. So if you want to focus as an investor specifically on climate, you can find mutual funds or stocks or bonds that are specialized on that particular asset class.
Mm-hmm. But you mentioned that investors are becoming more and more aware of this, but how? Historically speaking, it's not like weather news have been impacting investment returns, but why now it starts to matter?
I would say that the physical evidence of the damage of the heating of global temperatures is becoming more and more visible, right? There are news reports of wildfires, droughts, floods, and warming of, say, the Arctic. All these reports are becoming more frequent. So the awareness of climate challenges to economies is becoming clearer and clearer.
Mm-hmm. So what is the current scale of this green finance, of these portfolios? Is it something that's already growing so fast, or it's still at starting point?
Yeah, so globally, there are about 120 trillion investable assets. Of those, about half are managed by asset managers. So say 50 to 60 trillion, depending on how you count it. In ESG, so environmental, social, and governance, in that asset class, there are about 3 trillion. So 3 trillion out of 60 trillion. And in climate funds, specific climate funds, they're only about 130 billion. So these asset classes are growing very quickly, but the total size is still very small. At the IMF, we have made calculations what it takes to transition to a greener economy globally. And that's of the order of $6 to $10 trillion of investments over the next decade. So the sector would have to grow tremendously to make a real difference in terms of providing financing for a greener economy globally.
Lots of people say that 2021 is the catalyst year for climate action. And we do see that anyone is talking about climate change, and all the companies are sort of promoting how green their business is, which leads to the question of, are they really that green? I guess within the topic of green finance, there's also this term of greenwashing, meaning that companies would just use green development as an excuse or even a disguise to keep polluting. Do you see this greenwashing as the major hurdle for the green finance to move forward, or how do you see these relations, or the regulatory, from the regulatory perspective?
On regulatory policy, there are 3 important buzzwords: data, disclosure, and taxonomies. So data is about the kind of data that companies or countries would have to produce about their climate impacts. And there's a very important initiative by the IFRS, the International Accounting Standard Board, that has started to work this year in 2021 on a data initiative for companies to disclose or to collect climate data. That would then be combined with disclosure policies. So the security market regulators would take those accounting standards on climate and say, this is what you have to disclose in your public documents. And then those disclosures can be used for taxonomies to basically classify different company activities into scores of how green they are or how polluting they are. So it's the data, the disclosure, and the taxonomy that is ultimately going to improve the data architecture around climate investing.
Mm-hmm. So back to the financial stability a little bit, although you said that this is relatively a new sector, but do you see whether there's any risk that this kind of green finance might pose to global financial stability?
Yeah, there are shorter term, medium term, and long term risks. So in the short term, many countries are already subject to climate catastrophe, but countries that can be hit by climate catastrophes such as hurricanes, wildfires, earthquakes, they are already impacted in a very real sense in the short term or at any time. Mm-hmm. Secondly, in the medium term, there's going to be a transition of the economy from polluting sectors into greener sectors. And so that reallocation of physical capital, of labor, and of investments going forward is going to generate winners and losers. And then finally, there's the major risk in, say, 30 to 50 years, which is the more long-term risk. And that's the question of whether the warming is going to be so dramatic that it will represent a catastrophic event for the entire global economy.
To finalize with a quick follow-up on this transition risk you mentioned, because automation replacing labor has been a topic that even the IMF has been talking about for a while, and now we have this green transition that might also cause this sort of redistribution of labor forces. How do you think the regulators should sort of prepare beforehand so that this transition risk might not be that fundamental to some people's livelihood?
Yeah, absolutely. We do two things here at the IMF, and many countries are acting in a similar fashion. So first of all, we are conducting climate stress tests. So this is looking at the portfolios of banks or insurance companies or other financial institutions and asking, what is going to happen to this portfolio as the transition to a greener economy is taking place? So what kind of losers and winners does a financial institution have in its portfolio, and what does it mean for its solvency and liquidity? This is climate stress testing. Secondly, there are enhanced supervision and regulation approaches where supervisors and regulators of banks and non-banks take a very deep look at the governance and the processes and the risk management around climate issues. Finally, there are also monetary policy steps. So more and more central banks are considering how to take climate risk into account into their monetary policy framework, and thus could have important signaling effects for the broader economy.